I would like to welcome everyone to PIER Economic Seminar, and it is our great pleasure today to have Professor Ben Olken as a speaker today. I would like to take a few minutes giving an intro to the professor. So Professor Benjamin Olken is the Jane Berkowitz Carlton and Dennis William Carlton Professor of Microeconomics at the MIT. His research focuses on development economics with a particular interest in improving the performance of the public sector in developing countries. He is also the faculty director of J. Powell at the MIT, the co-scientific director of J. Powell's Southeast Asia office, and also the co-chair of the J. Powell's Social Protection Initiative. Professor Olken received his PhD in economics from Harvard University in 2004. And for today's topics, he is going to talk about his AER paper on the tax administrations versus tax rates, evidence from the corporate taxation in Indonesia. He is going to present for around 40 minutes, which will then be followed by the Q&A. But if in case you have any questions along the presentation, please feel free to interrupt and ask. Okay, so without further ado, the floor is yours, Professor.
Great. Thank you very much. I'm delighted to be here and delighted to present this paper. And just wanted to echo, please, I'm used to economics style discussions where people interrupt, raise their hand or don't even raise their hand and interrupt. And it's much more interesting if we kind of have a conversation rather than wait to the end. So I really encourage you to don't be shy and ask questions as we go. So this talk is called Tax Administration versus Tax Rates, Evidence from Corporate Taxation in Indonesia. And this is joint work with Khatib Basri, who's our colleague at the University of Indonesia, also was the former Minister of Finance of Indonesia. Mayara Felix, who was a graduate student at MIT when we wrote this paper. She's now a postdoc at Princeton and will be an assistant professor at Yale starting in a year. And Rima Hanna from the Harvard Kennedy School, who I think some of you saw a few months ago. Okay, so the general issue is that low tax revenue is a challenge for many low and middle income countries. Many countries collect 10 to 20% of GDP in tax compared to say 40% for OECD or high income countries. And there's this question of sort of like, do countries have the ability to raise more revenue, or are they kind of fundamentally limited by sort of their administrative capacity? And in some sense, there's been several different pieces of academic literature that have made the argument that small tweaks to tax administration here or there can make a difference, but we want to ask kind of holistically, how does like a large scale improvement in tax administration capacity, how much of a difference can that make? And then we sort of want to benchmark that to changing tax rates. Like I think if you were to take many public finance classes, they would be focused on what is the optimal tax schedule and how do we think about the optimal tax rate as a function of elasticities and things like that. And there's a lot of discussion in the policy world of should we raise rates, should we lower the corporate tax rate, raise the corporate tax rate? And we want to say, well, how does that whole question about raising rates, how does that compare to just sort of improving the administration and collecting more revenue against the rates you already have? So that's what we want to think about in this paper, okay? And we're going to do that by comparing two changes that happened in Indonesia. One is a large-scale administrative reform that increased the size, that increased administrative capacity, which I'll tell you about. And one is a regular sort of change in the corporate tax schedule. Okay, so which was differential for different firms. So we'll use that to say to estimate kind of what is the elasticity of taxable income, and that's going to allow us to benchmark kind of these administrative changes to changes in the tax rate. And I'll explain all of that as we go. Okay, so in particular, we're going to study two different corporate tax reforms in Indonesia. So the first one is a taxpayer administration reform that happened in 2007. In particular, as many of you know, corporate taxes are very skewed. So most of the tax is paid by a few large corporate taxpayers, a few big companies. So many countries around the world, including I think Thailand, have like large taxpayer offices that handle the special largest taxpayers with enhanced administrative capacity. So Indonesia in 2007 took the next step and said, let's take that same idea and use it at the regional level. So Indonesia, Indonesia is a big place. They have 19 regions across the country, and in each region, they opened what they called a medium taxpayer office, or an MTO, which is essentially the same idea as a large taxpayer office, but for each of these 19 regions. So these are special offices with like much higher sort of staff to taxpayer ratios that service about 300 or so of the largest corporate taxpayers in each of the 19 regions. And so we want to see what happens and when those get turned on, basically. And we're going to do that using a match difference in difference design. So we're going to compare kind of firms that get assigned to the MTO to similar firms that don't get assigned to the MTO. That's going to be the design. Okay. And one thing I think that may be sort of relevant here is that we're going to show that it seems to be, they have large effects. And interestingly, just to preview some of the results, you would normally think when we raise the effective tax rate, that's going to lower firm growth, right? Because you've raised the tax rate, right? Typically, we think that higher taxes lower firm growth. We don't see any evidence of that at all. If anything, it looks like firm growth increases after the tax for these firms. And one idea that we're going to suggest, possibly, is that this is kind of like a reduction in size-dependent enforcement. So essentially, in the old system, when they had limited capacity, who do they go after? They go after the big guys. So that means that you have to worry about becoming too big, because if you become too big, then you're going to get taxed. Once you get moved to the MTO, that's already happened. You're already being taxed. So there's no additional disincentive to grow further, because that's kind of sunk at that incentive. So we have some suggested evidence along those lines. Okay, that's first reform. Second reform is a change in tax rates, which took place about a year or two later. And basically, essentially, the pre-system was a progressive corporate income tax rate where the tax rate was based on taxable income, like profits. Okay, so 3 different tax brackets based on your taxable income. The new system that they switched to, the tax rate was a function of your gross revenues, not your profits. Okay, so that means that some firms got a tax cut, some firms got a tax increase, depending on sort of where you were on taxable profits relative to taxable income, net income versus gross income, right? So it's sort of a shift around, and we'll use that to estimate the elasticity of taxable income. And then we're going to compare the two. Okay, so that's the basic plan of the paper. Okay, and just to give you a preview of the results so you know where I'm going, the short answer is that the administration reforms were really effective. So it looks like the affected firms, their tax increase, their tax payments were 127% higher on average for 6 years after the reform. So like a really big impact, right? The cost to the government of this are minuscule. So like the additional costs of operating the MTO are like only 1.5% the cost of the additional revenue they get. So it's like hugely profitable for the government. We get similar effects kind of across the taxes they pay. So value-added tax, corporate income tax, withholding taxes, and they all go up. Everything goes up by similar rates. One thing that's interesting is we see it's not that they're like scrutinizing deductions more or things like that. It looks like it's more top-line revenue is going up. So I think that the first thing that probably happened is there was just a bunch of business activities that were kind of off the books, and they kind of like discover those, and they all come in. So everything goes up. So the revenue goes up, costs go up, everything goes up kind of proportionally. It's like, so it's as if like you can imagine like there was a firm that had some on the books businesses and some off the books businesses, and they went and discovered them, and they brought all the off the books business on the books, is I think kind of a reasonable way of interpreting what happened. But also, as I mentioned, that these effects grow over time. They don't shrink over time. So it's not as if this higher effective tax rate is reducing firm growth. So that's also pretty important. Okay, so that's about it. Not if it's consistent with my business being brought on the books theory. Because withholding taxes are about half of employees. Yeah. Unless they were all like off the books, not being officially reported. The whole business was being run kind of like under the table. Then that's the simplest explanation I have is that. There was a bunch of stuff where the whole thing was being held kind of like under the table, and the whole thing got discovered and reported for everything. That's my best. That's the simplest explanation that explains the facts that I can think of.
Yeah, I think there are some papers that are trying to say that when you are involved with more employees, there are like higher risk of whistleblower.
Yeah. But this is the same firms. So you'll see the results in a second. So it's the same firms. Okay. And I already explained this. Okay. The second thing is we then, using the tax rate change, estimate elasticity of taxable income of 0.6, 0.59. What does that mean? Well, just in general, one thing it means that Indonesia is below the LAFA rate, so you can compute what there's actually a big debate in Indonesia of was the corporate tax rate, above the LAFA rate or not, and the answer we think is like definitely no. Like the LAFA rate is 57% or something, so like it's definitely, the rate is 25 to 30% depending on some stuff, and so it's definitely below the LAFA rate, so that's like an important fact. But the other thing that's helpful is that you can then use that elasticity of taxable income to calculate how much, let's just focus on corporate income tax, okay? So let's forget about the VAT and the withholding stuff, just corporate income tax. What would you have had to do to raise the income taxes to get the rate to get the same amount of revenue? And the answer is you would have had to raise the tax rate on all firms, not just the affected firms, all firms, excluding the LTO firms, by the way, because they're not our data, all the MTO and small firm, everybody, by 8 percentage points, by 30 to 38%. So it's a pretty big increase, right? And there's some argument that I'll make that suggests this is kind of a welfare improving. There's a theory of which you do, and this says that this administration one's better. Okay. All right, that's the preview. Okay. I'm just keeping an eye on the time. All right. So what do you need to know about Indonesia and taxes for this paper? Not much. There's three taxes we're going to look for that are remitted by corporations. Corporate income tax. The current rate is of 25%, but more on that in a sec. A value-added tax, which is a flat 10% VAT, and withholding taxes for employees. Payments are remitted monthly, and we have payment data. We also have the annual tax filing, and that's due April of the following year. Okay, so it's a calendar year system. April is when the taxes, your filings are due. And there's a central director general of taxation that sort of runs the whole thing for everybody. And there's about, I should say, I think about 300 or so tax offices across the country. I think I already explained what I need to explain about the MTOs. As I mentioned, they handle about 300 corporate taxpayers per office, which is about the top 4% or so of taxpayers in each region. So it's really kind of like a very small group. And the key thing, they're organized exactly the same as the primary tax offices. They have the same internal organization structure, same everything, same rules. It's just that they have like 4 times as many staff per taxpayer. Okay. And they per corporate, and they don't have to deal with individual taxpayers at all. And then we're going to focus on a few of the regions happened early. We're just going to make life simple. For some other reasons, we're going to focus on the 13 regions where they opened it in 2007. So it's basically going to be kind of a pre-post in 2007 for the affected firms. But you can do the analysis for all 19, and it looks pretty similar. Yeah.
So how far can we generalize these results? For example, okay, this is a good way to make money for the government. Can I increase the number of firms that are going to be in this MTO? How many? Until when we should stop?
Can't tell you. Can't tell you. I mean, I think this says that the marginal one, well, I can tell you one thing actually, which is that the firms that we're looking at are, because we're going to do matching, we're comparing firms that are similar. So we're going to look for comparable firms that are comparable in the MTO and not MTO. That's going to mean that the firms we're going to focus on are going to be the smaller MTO firms. Okay, compared to the larger non-MTO firms. That's relevant to your question because I think it means that our estimates are particularly relevant for the question of what would you do if you marginally expanded and got the next group in. So it doesn't tell you how far you should go, but it does tell you, like, it's closer to kind of what would be the marginal effect of adding new ones as opposed to the average effect from the big ones. Yeah.
Indonesia is a unique country, right?
Is it what?
It's a unique country. It's an island. It's an island country, right? So, like the way, if you look at the headquarters, in order to reach its regional offices, could be a bit difficult than if you look at say Thailand. If we want to reach our central office, it's a bit easier.
So this is, I think this is about the tax offices where, turn off your mic. Yeah, this is it's where your firm is located. It's the headquarters of the firm.
I'm sorry.
But the offices are all over the country.
Yeah.
I don't think it's a big deal. I mean, Indonesia, they fly around a lot. Like, Indonesia is one of the largest passenger air markets in the world. I don't think the island thing is particularly important, is my sense. And I bet you could do this all on Java and it would be probably similar, because 60% of the population is on Java. We haven't looked. I mean, the structure of Indonesian business is that most of the business activity takes place on Java or in a couple of provinces in Sumatra and 1 or 2 provinces of Sulawesi and a couple areas in Kalimantan. It's not that, there's not that much business activity happening in Eastern Indonesia. So, like, I think we could do this for Eastern Indonesia, but there's like essentially no big, there are very few kind of big businesses over in Eastern, you know, east of whatever, the eastern third of the country, there's not a lot of big business activity. That's one theory. No. The main thing I'm arguing is that this is about the main effect is just like they found a bunch of business that was off the books and they found them and they taxed them. That's the main thing. There's this additional effect, which is to say, why did this not discourage firm growth? And I think that's the flattening point, which I'll show you a little bit of evidence on. But that's not the main story. That's like that's why it doesn't look like up and then down. You'll see it goes up and then up, and I think that may be why. That's all I'm saying. Okay, great. Okay. And what's the corporate income tax reform? So the corporate income tax reform, I said it a little bit before, but it's a little complicated. So just to explain it, do I have a clue? Yeah. Okay. So the old system was your taxation was based on your taxable income with 3 bins, 10, 15, 30, depending on your taxable income, like a kink basis, normal sort of 3 tax brackets. They switched it in 2009 to be a tax rate which was either 28% in 2009 and then 25% in 2010, which was a function of your total revenue. And basically, if your revenue was below 4.8 billion rupiah, which is like, I think, $500,000, roughly, it was half of that. If it was above 50 billion rupiah, which is like $5 million US, it was like the rate. And then it was this kind of like funky function in between, which we had to figure out from reading the revenue. Yes, exactly. So that's what it looks like. So Pitti solved the equation in your head. So exactly, it looks like this. So this is the tax rates. But note that on the x-axis switches. So the pre-period tax, this is the marginal tax rate on any additional dollar of taxable income, switches from this scheme, which is like a normal three-tier, 3 tax bracket scheme as a function of taxable income, to this thing where the marginal tax rate depends on your gross income, right, your revenues, with this kind of funky shape. Okay, so that's the reform. And by the way, I don't think it's a separate matter. There's a question of why did they do this, and I think if you think about, if you want to have a progressive corporate income tax rate, it's not clear you do, but if you want to have a progressive corporate income tax rate, I think the idea is gross revenue is a better measure of firm size than profits, and that's kind of why they switched it, I think. So I think that basically these 4.8 billion is 4.8 billion is it's, I think, the VAT threshold. So I think it's like a pretty salient number in their tax code for like when you're a small firm or something. I think it's the VAT. Don't quote me on that. I think it's the VAT threshold. And so that was kind of like, that's small firms. And then they wanted to kind of phase it, and 50 billion, I guess, was big firms, and they wanted to phase it out in some gradual way. And why this way, I don't know. The idea is basically, this is like what fraction of your revenue is below 4.8 is what gives you this curve. But then they have this notch at 50. I don't know why. This is the rule. We read the tax code. We made the picture, but like, yeah, I didn't write the tax code.
In terms of incentives, whether this is better for incentives, you know, less.
Well, you want to have something smooth, right? You need to, I mean, you want to have something smooth, and you can't. The other thing is, this is a marginal rate applied to. So unlike this scheme, in this scheme, you could just have normal like step function thing, and you know, this is like continuous incentives, because you know, there's no notch here. Like, this is only applied to the dollars above this amount, right? So this is appreciated. But if you want to do the same thing here, you need to and you want to have it be increasing. It needs to increase in a smooth way, because every dollar of additional revenue changes your tax rate for the entire profit. So it needs to be smooth. So it's smooth, except for the little notch here. It's otherwise smooth. And why does it have this curve thing as opposed to linear? I don't know. But I didn't write the tax code, but this is what the tax code is. Like, I'm very sure this is what the tax code is, but like, okay. You know, we don't actually use the notch very much. I can show you, if I clicked on this button, you would see there's a little bit of bunching at the notch, but we're not going to use the notch very much. Yeah. Yes. If you click, okay, if you click the notch, if you click the button, can you click the button? No, that's a notch. It's a notch. Go back. In the old system, it's a kink. The new system is a notch. It's a notch on your gross income. So your gross income is 49.9 billion. Then you pay whatever 26%, and if it's 50 billion, you pay 28%. So it's a notch. It's a small notch, but it's a notch. Yes. Yeah, it's a notch. So and if you click on the button, can you click on the button? This question comes up, so that's why we have the button. Click the notch button. Okay, so there's a little bit of bunching like above the notch. It goes from like here to like, there's a little bit kind of like just below the notch. It goes up a little bit and then kind of down a little below. So that line, if you were to draw a line here, you would see that line looks like a little bit. Oh, sorry, no, the other way around. Actually, sorry. There's less right at the. That was the point. Sorry. If you look down, it's a little bit less at the notch, but not much. So we're not going to do much with the notch. Click. Okay. Can you click this little button right here? Yeah. It's a disincentive, but it's small. We don't see a lot of bunching, so I don't think we should make much of it. Not that I know of that are going to be relevant. There is a differential VAT regime, but I don't think that affects CIT. That I know of. Okay. Plus, yeah. Okay. All right. But actually, what we're going to do, I'll show you later how we're going to use that. So the changes we're going to use are big, sort of, which I will show you in a second. Okay. And the data that we have is we have anonymized administrative data from the tax authority from 2003 to 2011 of all the corporate taxpayers, except for a few groups. They didn't give us the LTO taxpayers, and they didn't give us foreign firms or publicly traded firms or firms in oil and gas, which are all handled through separate tax offices. But the rest of it is the anonymized administrative data. And we have filings and actual tax payments. We have some other stuff. Okay. All right. I'm not, in the interest of time, I'm not going to go through the model I'm not going to go through the model. So let me just, trust me, there's a theoretical model in the paper. It basically, but actually, let me just say one thing about the model is that the reason we wrote the model is I didn't see off the top of, there wasn't a great off-the-shelf model that I knew of, or that we knew of, that captured this idea that there's like a bunch of business on the books and a bunch of business off the books, and you can sort of bring the businesses on the books and what that would sort of look like. So the theoretical model has those features and just sort of is a way of kind of writing that down and kind of micro-founding what that might look like. So if you're interested, it's in the paper. Okay. All right. And I'm going to skip this. Okay. This is what I'm going to actually talk about. The theoretical point, and this actually comes from a paper by Keen and Slemrod, which we're going to adapt to our context, and sort of, in some sense, we micro-found the corporate tax version of this Keen and Slemrod JPEG paper. But basically, it says, well, how do we think about the welfare consequences? So stepping way back, the papers by like Feldstein and Chetty sort of say, Feldstein and Chetty basically say, how do we think about the welfare costs of a tax change, of a marginal tax rate change? And they say, well, actually, it turns out that it's really convenient. The thing you actually need to worry about is just the change in actual tax revenue. And they sort of derive that result. If evasion costs are real costs, that's the argument. And so Keen and Slemrod sort of say, well, how do we do this? How do we think about this issue if we're doing a change in administration, an improvement in tax administration? So it's kind of a very handy paper that was written like a couple years before we wrote our paper, so we can kind of use their model. So the key point is this. The key point is there's three terms for change. So alpha in our model is the change in tax administration. So what is the change in social welfare as we improve tax administration? Well, it's three things. There's three terms. The first is there's this term over here is the actually sorry, two terms. This term over here is what we observe. This term is what we observe. This is the change in tax revenue. So Z is taxable income, tau is tax rate. So tau delta Z is like, this is the change in taxable income multiplied by the tax rate. This is the change in reported taxes. Okay. So that's the key thing we're going to estimate is how does tax collection change? The second thing you need to know is for social welfare, there are real costs the government is expending to collect all this money. They have to hire all these staff and whatever, and that's this term. So what you actually care about is not the gross amount of revenue the government gets, but what is the net revenue, the amount of revenue the government gets minus the real cost it pays for tax administration. But that we know too, actually, so we're going to estimate this, and we know this because we have their budget data. So we just know how much these MTOs cost to operate and how much the regular ones cost to operate, and we can figure it out per taxpayer, so we know what that number is. That's a small number, as it turns out, but we have to calculate that. The third thing, which their framework tells you, is you also have to know, like, if a improved tax administration, is it more costly for the firm to comply with a new tax administration? And that we don't observe. Okay, that's like an unobserved thing. So we're going to do two things. We can bound this number, so we know this, and we can say, well, how bad could this thing possibly be for the welfare effect to not be positive, right? And the answer is it would have to be like really huge because our welfare effects are really huge. So that's kind of and the other thing is we have a little bit of survey evidence that suggests that actually this thing is not even negative. That actually the firms may have even liked being in the MTO and actually report it was kind of like made their life easier because actually they could call the tax office and someone would pick up the phone and like answer their questions. And so like actually it was like maybe the compliance costs were actually lower because they were kind of getting better service. So actually it's not even clear this thing is even negative. So I can talk about that a little bit. Same thing. Because they get better service. Exactly. And I think that there's a lot of this, which I think that there's a broader point here, which I think is super interesting, which I can't quite get at in this paper, but I think is really interesting, which is you know, all the economic models are kind of written in this view of like, I've been optimizing, like this Allingham-Sammo framework, like I'm an optimizing firm, I want to pay as little tax as possible, I want to evade whenever I can, and the government is going to like audit me and like prevent me from invading. And that's kind of the standard like economic model of taxation that we all see. But I think there's this other model, which is that some firms are actually like, I'm just going to, I'll comply with the law, I'll do what I'm supposed to do, but it's a huge pain. So if you can just make it like easy for me, I'll just do it because I'd rather be legal. And like, so it's kind of in that world, there's kind of this like win, it's not necessarily adversarial. And I think I'm not like naive enough to think that everybody operates that way, but I think that what you hear from firms, actually, some of them are really sort of saying like, if you just like make it straightforward, it's not a huge cost for me, I'll just do it. But the administration costs are such a hassle that like, I don't want to do it. So I think there's a little bit of that in there as well.
So would that size of firm matters? I mean, how this, I mean.
So these firms, all the ones we're going to study, I'll show you how, all the ones we're going to study are the firms around the sort of like, let's say, you know, 600th to 150th firm in each region of the country. So these are not like the giant conglomerates, because those are all in the LTO, and they're not like little tiny firms either. So, you know, I have some stats on later. Okay. And the final thing is you can also calculate this thing here. What is this in math? This is just saying, well, how large a tax rate what would the tax change need to be in the marginal tax rate to sort of, you know, get the same amount of revenue? And basically that is the sort of the net, it's the net change in the government's revenue, the same thing we calculated before, essentially divided by, you know, adjusted for the elasticity of taxable income. So that's all that is. So so the point is we need this other, in order to say like, if you start raising taxes, of course, as you raise taxes, you get less and less revenue. You have to, if you want to calculate how much would taxes go up, you can't just like mechanically divide. You have to sort of adjust for this elasticity of taxable income. So that's why we need the second piece of the paper. Okay. So that's it for the theory. So now I've got about 10 minutes. Okay. Okay, so maybe I'll go a little more. We'll see. Okay, so so how do we estimate this thing? So the key in PIER issue is that if you just compared the firms that move to the MTO and the firms that don't move to the MTO, they're not comparable because by definition, the big firms went to the MTO. But it turns out that, so what we're going to do is we're going to do matching. Okay, so can you click this button, please? Okay, so this is an example of, for in like pre-period baseline values of like log of revenues, for example. We're going to match actually on two variables. We're going to match on gross income and on net income, because those were the two things that they used to sort of assign firms. So this is the MTO group. This is the non-MTO group. So you can see that the MTO firms are obviously like a lot bigger, but it's not like perfect overlap. So what we're going to do is we're going to basically, we're going to draw lines at the top 2.5% of the control group and the bottom 2.5% of the treatment group. That's where those lines come from. And we're going to call this our kind of overlapping set, where there's sufficient mass that we can kind of find comparable firms. And we're going to do this for both gross income and taxes paid. And then, if you can click back on this little back arrow here, you may have to click it like 3 times. Oh, that worked. Great. Okay. We're going to match basically based on that. So we're going to take the overlapping set and we're going to do this. There's this actually very nice technique by Heinmiller, which basically you tell it what you want to match on and it finds kind of the weights in your sample that sort of matches the firms as best as possible. So you can think of it as we took the set, the smaller firms from the MTO and the larger firms from the non-MTO, and we further matched. And you might, by the way, some people often ask, why is it not a regression discontinuity? It's not a regression discontinuity because the actual Excel sheets they used to do the assignment were lost. So we can't figure out, we know they told us what they did, but they did it in Excel, and like we can't find the Excel sheets. So it's very strong, like those two variables are very strongly predictive of being in the MTO, but not discontinuously so. So that's why we have to do matching. And that's like a year of work, just that sentence. Okay. All right. So what do we find? So this is the results. So this is, so the treatment starts in 2007, but partially affects tax year 2006 because that's filed in 2007. So the MTO goes live January 1, 2007. Okay. Yeah, it goes live. It goes live here, but it partially affects this previous tax year because you file your taxes for 2006. So you can see they sort of look on similar pre-trends, and then boom, kind of revenue sort of totally takes off in the MTO. This is the MTO firms, this is the non-MTO firms. These are just raw averages. If you run this as a difference in difference regression, it looks like this. Okay, so this is the partial year, this is the first full year, and this is the other point that I made out, which is that then it doesn't go down. It like, if anything, it continues to go up, right? And this is total tax payments, log total tax payments. Oh no, level of total tax payments, level of total tax payments. Yeah. It's VAT from your firm, yeah. Yeah, it's just the actual amount remitted by my firm for VAT, which is the net. Yeah. Okay, and so you can see sort of like these are the percent increases. So basically, what is the percent increase? It's similar across the board. That's what I was sort of saying. It's basically like around 127% and sort of similar across the three types of taxes. Okay, so this is big. It's like it increases the tax revenue by 127%. So if you extrapolate it to all the MTO firms in Indonesia, it's like about $4 billion over 6 years. It's not that the control group is changing; it's that the treatment group is changing. So you can sort of see that in the first graph.
Why does it keep increasing?
What?
Why does it keep like increasing after the?
That's what I'm going to talk about. Hold on. Okay. Yeah. Oh, great question. We include, what do we do? That's a great question, Nada. I think we're not including new firms because we're conditioned, so we're not including new firms. I want to say if you exit, we count you as a zero. I'm pretty sure if you exit, you count as a zero, but I should double check. So the cost to the government per taxpayer was something like 8 million. So they gain about 500 million or $50,000 per taxpayer per year. In additional revenue. It costs them $800 per taxpayer per year in additional costs, which is, if you think about it, that's like per tax, that's like, I don't know, like a couple months, $800 is probably, I don't know salaries are a couple months salary of a tax officer, and then each tax officer handles a certain number of firms. So, but it's substantial, 2 orders of magnitude smaller. So that's why you sort of say it's like a huge return for the government. Okay. The next point I want to say is that this effect occurs for top line, like gross incomes, not just net income. So that's what I was saying. If we look at total reported revenues by the firm, the pattern is pretty similar. It's not quite as like stark, but it's going up, right? It's not the case that this is about just like they reduced kind of your ability to deduct stuff or whatever, and it's not about changing like your ability, whether they actually collect or collect payments. It's really about sort of discovering kind of more business activity or more business activity happening. We can't distinguish between those two, but top line revenue is going up. Okay.
So you're talking about a possibility that these MTO just found out some, under the table business, right? That's why they get more revenue. So before this MTO reform, those revenue or those firm revenue, do you include those who usually not on the book?
I'm sorry, say it again.
So your theory was like why the government get more revenue, because now they found out there's some business out of the book. Then in the graph that you just showed, did you include those revenue of the firm that's out of the book?
Well, we don't.
Prior to that.
No, all we know is the revenue that the government observes.
Okay, so therefore,
this is all from the tax data. This is all what the we don't have any measure of the real activity. We just observe the tax data.
It's possible that actually they don't change anything. They just keep operating. They might have the same revenue, but at least they don't decrease. I think that's what matters.
Possibly, exactly. Either consistent with new business being brought on the books or firm growth. The key is it's not going down. I mean, there's two things that I think are important. The first is it's not going down. And the second is this effect is not about collecting more, like some people like didn't pay the taxes they were due. It's not that. And it's not that they used to sort of like have a bunch of kind of dodgy like deductions that they were disallowed. It's not that either. It's like more, it's really driven by sort of more top line revenue and collecting the tax against that. That's the main effect. That's kind of the main point. Okay. We also find more workers on that are getting on the payroll as well, on the formal payroll. Okay. Okay. So now this is what Atifada was asking. So what is so we have this theory that maybe this is about. So one possible explanation for. So the question is what not. The question is why does it not go down? Why does it keep growing more differentially in the MT group? And one theory that we have is that maybe it reduced size-dependent enforcement, and so we can look at that in the data. So what we have is we have a very small subset of the administrative actions we observe in the data. So we observe a formal audit, whether it happens or not. We observe a VAT underpayment letter and a VAT collection letter. So like, are we sort of like, is the government doing more stuff kind of to you? And we can look at how does that relate to kind of your baseline, your firm size. And so what does it look like? I think this is kind of, as a function of taxes paid, it's a little less clear, but if you look as a function of workers, like in the MTO, your probability of like an audit is very strongly, in the non-MTO, your probability of audit is very strictly increasing. Like they really audit the large firms more. In the MTO, it's much flatter, right? Like, it's not that these guys are less likely to be audited, it's everyone kind of goes up and the whole thing flattens. And so we see that in this activity, we see it over here in sort of, at least here for taxes paid, and we see it over here for these VAT underpayments. We see it here for these collection letters. So there's this pattern that they were definitely doing size-dependent enforcement in the kind of regular, maybe overwhelmed system, and they don't have to do it anymore when they move to the MTO system. Now, I can't prove to you that this caused the firm growth, but it's one hypothesis that is at least consistent with some of the administrative data. There was this reduction in size-dependent enforcement. That's all I can say. So I know I'm like out of my 40 minutes, but I'd like to take, can I 5 minutes?
Don't worry about that.
Okay.
Because people ask you a lot.
Okay, fine. So what do we learn from the paper thus far? We say, look, so it led to substantially higher tax revenues across all tax types, driven by more top-line revenues, did not slow the rate of firm growth, and appears to reduce the firm size-dependent enforcement. So the next question is, how does this compare to raising tax rates? So that's the second thing we're going to do. Blah, 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 blah. And I think I already explained how we're going to do it. We're going to use this change in the two tax schedules. So can you click this button? Okay. What is this pretty picture? This picture shows you in the pre-year your 2008 gross income and your 2008 taxable income. And I then am going to basically kind of like superimpose the old schedule and the new schedule and say which are the firms that are likely to get tax increases and tax cuts. Okay? So this is So I take your 2008 tax, your pre-period gross and net. I compute your marginal tax rate on the old schedule and your marginal tax rate on the new schedule, and then the colors are the difference. Okay? So what you can see is that basically the people who have very low taxable income but high gross income, they're the ones who are getting big tax increases, right? Because they were paying that low, they were in the lowest bracket in the old system, they're not anymore. And then conversely, if your taxable income was already kind of in the top bracket before, most people are getting tax cuts, but the size of your tax cut depends on kind of where you are on your gross income. So the colors essentially are sort of what your tax rate depends on is kind of this nonlinear complicated function of the two different things in the x and y axis. Okay, so that's what we're going to use to estimate that. And the dots just sort of show you that we have firms kind of everywhere, right? And the black dots, I think, are the MTO firms, and the white dots are the PTO firms, I think. But you can see we have dots kind of everywhere. So that's going to so we can estimate this. You can click the back button or the back button. No, why? Oh. No. But to be clear, they're not levying. The tax is always levied on taxable income. It's just a question of the marginal rate. So yes, it is true that in the old system, your marginal rate would investing a lot would lower your marginal rate, but that's probably secondary to the fact that it just lowers your taxable income. Like the first order effect is it lowers your taxable income. The fact that it lowers the marginal rate is probably secondary. So I agree with you. You're right, but I think it's like.
So they cut tax rate, statutory tax rate.
Huh?
And they cut statutory tax rate, but then.
Well, they cut it in rate. I mean, they cut the top rate. They cut the top rate, but they made it depend on gross income. So the key thing that's really driving this is the switch from the rate depending on taxable income to the rate depending on gross income, and that's what gives us kind of a lot of variation. Who gets a tax increase? Who gets a tax decrease?
That's very creative. Usually, you would not find the change.
What? Usually, you would not find this change. No, we were.
You would not find the change.
No, I didn't make up this change. No. Nor was our, and this was even before our co-author who was finance minister, was before he was finance minister. So he's not responsible for the change either. He came later in the period. So no, it's just
Indonesia is having so many like creative things. Like
well, I mean, but actually, in all seriousness, like how did this paper come about? This paper came about because Mayara, a graduate student, went to Indonesia for like 4 weeks and interviewed everyone in the tax authority and was basically like, tell me every tax policy you've changed in the last 15 years, and made a long list. And then we sort of said, what are these that sort of be useful for writing a paper? And these were the two that we found that would kind of be useful, and sort of figured out how to marry them together. I think there's a little bit of like that, sort of like. No, I would love to do a project on the tax amnesty in Indonesia, but I think the data would be very challenging to get, and I haven't figured out a good identification strategy either. But we can talk about that later. Yeah. Okay. Can you click the back button a couple times here? This little button down here. Click it twice. Click it. Click it again. No. Okay. Try clicking this back to intro button. Okay, that's fine. So then what are we going to do? So now we're going to just sort of run a standard, this is a standard regression from the literature where basically you estimate the change in taxable income. This is the log change in taxable income as a function of the change in the net of tax rates. And you instrument for, and two things. Number one, because this thing is a function of this nonlinear function of the colors, we can control for the x-axis and control for the y-axis separately. That's this. And then we can we instrument with this with the predicted tax change that comes from the change in the tax schedule. And the final thing is we have this additional tax change, which happens the second year, which I didn't go into, which they cut the top rate from 28 to 25, and that sort of like thunks down that whole curve in kind of a not totally linear way, and that gets us additional tax changes. So we also have like an additional thing we can do, which lets us do this whole thing with firm fixed effects. Okay. So when we do all this, first of all, the predicted tax change from the tax schedule predicts the actual marginal tax rate almost perfectly. That's not surprising. That's good. And then the key thing is we get an elasticity of like 0.6. And a lot of people ask us the question, is the elasticity different if you're in the MTO and the LTO? And the short answer is maybe it's a little bit smaller, but we don't have enough statistical power to really say. So the point estimates are it's different, but that's not statistically significantly different. So we're not going to do much with that. But the estimate is like 0.6. So how do we use 0.6? So the key thing is we can say, I'm going to skip this. The key thing is this. So we can say, how much would the tax have had to change if to get that same amount of revenue, taking into account the fact that as you start to raise taxes, like they're less and less affected because of the associated taxable income. So basically that's just this formula over here, and the only thing that's that makes this formula a little bit non-standard is we had the 3 different buckets, so we're just going to compute a marginal tax rate change for the top rate, which I think is neither here nor there. And the answer is that if you tried to raise the corporate income, raise that amount of revenue, you would need to raise the tax rate on all firms in our data by 8 percentage points. And it's also interesting to note that if you wanted to get that amount of revenue from those firms, if you said like the amount of revenue, remember the revenue is only coming from the MTO firms. If you wanted to get that revenue from those firms, you could not do it by raising the tax rate because you would be above the Laffer rate, right? There's not enough of them. So another way of saying it is that like there's no possible way you could have gotten this much revenue from these firms just by raising the rate. But you could have done it from all the firms by 8%. Okay. And then the final point I'll just say is like, is this kind of higher in welfare terms? Well, like that's, that you basically have to say like, how do I think about that? This is basically the change in revenue divided. This is the change in revenue. Is this welfare improving or not? The formula that I didn't really derive, but is derived in the paper, basically says, how do I know? The question is, remember if I said that thing in the beginning, is it greater or less than 0? What is that? Well, it's the change in revenue. It turns out that formula is the change in net revenue to the government divided by 1 over tau minus tau times elasticity. Roughly speaking, is that thing greater than the change in private compliance costs? Okay. So the answer is, this thing is welfare improving so long as the additional compliance costs to firms from being in the MTO are not like 140% bigger than the additional revenue the government gets. That's kind of roughly the answer. So that is to say, if each firm is paying $50,000 in more taxes, this thing is only a bad idea for Indonesia. If you'd only rather do the tax rate version if in fact the additional costs of complying with this MTO are like $75,000 or more. And then the final point, as I mentioned, is that we don't really know much about this, but they had a small survey which we found. We didn't get the microdata, but we got a PowerPoint of the survey, which AC Nielsen sort of surveyed firms and said, well, how do you like, what's your overall experience dealing with the tax authority? And just like Atifat said for the LTO firms, they basically are like, it's way better to be in the MTO because it makes our life easier and kind of makes our compliance kind of simpler or whatever. So I actually think it's plausible that the change in compliance costs actually goes, like it's actually easier to comply with your taxes if you're in the MTO world. So all that by way of saying, that seems to suggest that this is like that improving your tax revenue by these big improvements in administration is useful. So to sum up, what's the point of the paper? So we want to compare these 2 different effects: a big change in improvement in administration with a change in changing rates. The short answer is the enhanced administration was sort of very effective, and had really large increases in revenue. And it's equivalent to sort of raising the marginal tax rate by 8 percentage points. So it's a pretty big change. And it's probably, and one reason that it may have been particularly effective was we think it also had this additional side effect of kind of lowering the size dependence on firms. And one thing that's not in the slides, but I'll just mention, is one additional thing I'll note is that this research actually, I think, had some direct policy implications, which is the tax authority thought this was like really great and like really good news. Last year or within the last year or two, I think kind of largely based on the fact that we found these MTOs to be so successful, doubled the number of MTOs in the country, and sort of to your point, kind of expanded the firms. They doubled the number of firms kind of subject to them because they thought it would be a good idea. So I think that actually it's also a nice example of, and just stepping back a bit, this is a nice example where, how did we start working on this project? We were interested in doing work on tax administration. Our colleague and co-author Khatib Basri connected us to some people in the tax authority. We talked to them and said, well, what were the big things you'd like to understand? And they said, well, this really big reform we did is this MTO thing. We'd like to know if it worked. Can you help us answer that question? We answered the question. The answer is like super yes, right? And they were like, great. And that actually, I think, then that sort of led into their sort of policy reforms and kind of a policy uptake of expanding exactly this. So I think it's also a really nice, in addition to I think being academically interesting, it's kind of a really nice example of kind of how I think researchers and policymakers can potentially have complementarities. So I'll leave it at that. Thank you.
Okay, thanks very much, Ben. Ben, can we do the Q&A for maybe 10 minutes? Okay, thanks. Yeah. Anybody have questions for Ben? And for those online, please use the raise hand button.
Yeah, I was actually wondering about the on the firm side, the ones who are being taxed. Either they are discovered and forced to pay tax, or they voluntarily, for convenience, there's someone close to them, they can actually go and file their taxes. Whether it makes a difference to their to their welfare, which reason it is. Because one of the reasons people like, well, I mean, the reason that you get the revenue, either you discover someone who doesn't want to pay taxes and you force them to pay tax. That's one possibility, right? And the other one is more convenient. As you said, there's an office close by. Now you can actually go and ask questions and file your taxes. Does it make a difference which reason it is that
yeah, it makes a little bit of a difference from the theory perspective, because it depends. It thinks about it's this number here. So like if it's so the welfare effects are kind of the net change for the government, or if I go back to sorry, just no, that's the comparing one. Yeah, this one. Okay, so the social welfare effects of the change are the net revenue change for the government minus private compliance costs. So it matters because if you think that basically like it's all the audit theory, then your view is that compliance costs probably went up because like they audit me and I have to like give them a bunch of paperwork and it's like really difficult and kind of unpleasant and my utility goes down. So that would reduce I still think that would have to be a really big effect for this not to be a good idea, but it would reduce the social welfare gains from this. If you think it's about it made my life easier and I'm really happy, then this thing is like 0, or maybe this thing is even the wrong sign, and that kind of further bumps the welfare effects. So it doesn't matter from a perspective of like just revenue for the government, but if you want to think about those as kind of real costs, you would want to think about them in a social welfare calculation.
Yeah, no, I was thinking more like why people want to like evade taxes, like in Thailand. The informal sector is like they don't want to pay taxes because if they have to, it's additional costs, right? If you now have to pay taxes, does it affect their investment, that type of cost, not so much audit costs. It's more
so I think that's why I think it's really interesting that the growth rate doesn't fall. So that's why I was saying, I think that like if you had asked people to predict what this would do, I think some people would have predicted maybe that you would have a big increase in revenue, but then a slower growth rate, right? So it would kind of look like up and then sort of down, right? Relative to the control group, because you get this big increase of revenue that you start taxing them, but then they face a higher effective tax rate, and that discourages investment. And I think the surprising thing we're finding is that doesn't seem to happen. Now, I should say, by the way, it could be that the one other alternative hypothesis that could explain why it still goes up is maybe like they discover most of the revenue the first year and they keep discovering more things like year after year after year. So that's possible. I mean, I think that's possible. But it's certainly, we don't see any evidence that the firms are like growing at a slower rate afterwards. A big caveat of this data, going back to your point earlier, is we only observe the tax data. And that's just all we observe.
Hi, can you hear me from an online audience?
Okay, shall we collect the question from online as well?
Hi, can anyone hear me from Sirikamon?
Yes, we can.
Okay, just out of curiosity, so when it's about tax administration, do you take into account the target, if there's any, for the Indonesian tax office to set for the MTO office to collect tax? I mean, it could be one of the reasons why tax collection for MTO is increasing and increasing.
Yeah, that's a great question. We're not actually studying that, but I agree with you. This question of the internal structure of the tax office and sort of what the implications of that are on the targets is really interesting. And I observe in many tax offices, tax departments that I've seen, they have these internal targets. I haven't studied them explicitly, but so no, it's not something we were looking at in this paper. But you know, the regular tax office, their targets are going up too. So you know, I don't know if they're going up differentially. That's an interesting point. We don't have data on their targets, so I don't know.
Sorry, I forgot to turn on my microphone. So firms try to be strategic, right? So when they, if they want to be small, they have to appear small to the officer. So they try to manage the revenue to expenditure ratio. But the fact that you show here, expenditure stay the same, revenue keep increasing.
No, expenditures go up too.
Okay, but you were saying that
the ratio stays the same.
So the ratio stay the same.
The ratio stays very similar. If you put the result, sorry.
Okay, so they increase revenue and they increase expenditure at the same time.
So here we can do it line item by line item on the tax return. So basically, your revenue increased, but your costs increase. So your like everything, and these are all kind of like roughly proportional. So not exactly, but you know, your revenue. Let's say your pre-period mean of revenue is 13. It goes up by 9, so that's 9 divided by 13, whatever that is, and 7 divided by 10. It's kind of similar ratios. That's why we're sort of framing it that way, because like everything goes up. But not the bottom line. No, the bottom line goes up too, but the same proportion. Yeah, so that's the profit margin, like the net income divided by gross income, is unchanged. Is there anything else that changed apart from? there's one, actually, there is one change, which is there's something about consolidating if you have different branches, but we aggregate everybody in the data anyway, so I don't think that's relevant. To the best of my knowledge, that's the only change, and we can undo that because we have your tax ID has like a company thing and then a branch thing, and we lump everything together at the company for all the analysis. So I don't think that's the issue. So not that I know of. That is one additional simplification. I think that we don't have enough data to really tease that out. Like 2007-ish. I think so, because these firms are all pretty big. Like I think these are all pretty big. I think they're all, my guess is that, so I don't know the answer to your question of whether it's still relevant today. My guess is yes, these are all pretty large firms, but I don't know exactly, hard to know for sure.
It's just more like a broader question in terms of applicability to other situations in other countries. If the theory that you said is about discovering untaxed firms or firms that are a bit below the line, then this would not apply for countries who are already formalized quite a bit. Right? Right. So
I think that's right. I mean, I think in general, it's going to depend on whether you think, but I should also say, like, there's a view that, like, I mean, it's also a question of where do you draw the margin. But yes, I think that it's a question. If you think you're already sort of, if you think, another way of saying it is, if you think you're already getting, that your enforcement is already really good, then
I was thinking about like intensive versus extensive margin. You got extensive.
But these firms are all partially formalized to begin with. These are all this is not totally informal firms because they wouldn't be in our data. These are all formal firms, and these are formal firms with an average of like 100 or 150 workers or something. So these are not like. So this is we didn't match on this, but like they have on average, say like 40-ish permanent workers and I don't know, between 50 and 100 temporary workers. So these are, that's the typical firm that we're sort of thinking about in our data. Okay. So you should think of these as like medium-sized manufacturing firms, for example.
A new staff to MTO, are they local or are they from like? From everywhere. Okay, so one possibility, one reason would be that they are not from that neighborhood, right? They are new. So the relationship, the potential corruption that might be going on is. Yeah.
But sorry, so we didn't look at that question. We could look at that question. We have that data, but we didn't check. We checked many other characteristics, and they look pretty similar. The staff, like they have about one more year of experience in, actually not the account representatives, actually. The auditors have like one more year of experience in the MTO versus non-MTO, but actually the account representatives they have about 0.4 years of experience. So they're a little bit more experienced, but not much. And we don't know, I didn't check if they're more likely to be local or not. My guess is, oh, I see. You're saying because they were rotated in?
Yes, and they are not.
Yeah. Good question. Great question. We have not checked. But in principle, we could check, actually. We do have that data. So this only affects corporate tax.
But they are the same regional office, right? They just have individual unit on.
Yeah, exactly. Yeah. So it doesn't change the collection of individual income tax.
So no change on PAT front, just corporate PAT.
Yeah, because the personal income tax is not administered by the MTOs.
Yes, but they are looking at that within.
Yeah. But every region is getting an MTO, so we can't really check either. Like every region gets an MTO. This whole analysis is comparing the firm. It's a firm level analysis. Which firms go to the MTO and which firms don't. So we can't really use that analysis for the PIT.
Okay. One last question. Or okay, no. Okay, so yeah, thanks very much, Ben, for sharing your interesting work and then having a very active session. Yeah, I hope we have learned something from you. Okay, so okay, so hope to see you again, Ben. Yeah, thanks. Yeah.